Good evening, ladies and gentlemen. This is Barry Norman on behalf of Trade Time, and welcome to our webinar on the economics calendar. Now, tonight's class is sponsored by one of the newest and most exciting trading platforms in the CFD and Forex arena, and that's Trade Time, www.tradetime.com. And they offer a very unique trading experience where everything is customized and personalized for your way of trading and for your requests. And you set up your customization. You can change it all you want, but you can select from a broad range of options to build your personal trading account. You have a wide variety of trading tools. Your funds are secured in segregated accounts, and you have a very unique, robust trading platform. As you can see on the screen, it's quite unique. Everything is done in a dynamic fashion, user-friendly environment, and it's very easy to access, use, and work with. So they have mobile application as well as an online application, and it offers one-click trading. It's intuitive, it's got advanced charts and indicators, and allows you to customize all the alerts that you need. They also push out very unique signals to you. The signals not only give you the asset, but they give you the first objective and the second objective. They tell you where to put your stop loss, which direction and what price to enter that direction. And you can also see simultaneously how many traders on the platform have traded with that signal as it's been pushed out. So when you have a minute, go to www.tradetime.com and set up your own demo account. There's no credit card required, no other information, username, password, and you'll be able to follow along using their information, or play with it all you want, customize it like you need it, and try out their platform. It is the next generation. So remember, go to www.tradetime.com. Now, tonight's class is being recorded. And in about 24 hours, if you want to see a recorded version of the class, just go to www.investing.com where you signed up for the webinar. Go under the Education tab or the Webinar tab, and then look for on-demand webinars and locate tonight's class. Now, tonight we're going to be talking about how to trade from the economics calendar. Now, the economics calendar is really about economic events, but it does include news because things like central bank meetings, which affect the news. You have speeches from, the heads of the central banks. You have the G20 summits. All of that is put onto your economics calendar. So not all the events on economics calendar are just data events. Now, this economic calendar allows you to predetermine and prepare for any of these events or news. And when I talk about news in this case, we're not talking about headlines. We're not talking about Donald Trump does this or this happens in the Gulf, because that's different. That's in up to the minute news. It's not economic news, but it does have an effect on the economic markets. Now, trading news can be very profitable if you can correctly guess which way the price is going to go. Now, the thing is, it can be very volatile, especially the undetermined news. What's going on with North Korea? Whether gold is found, what's happening with craziness with, a regulator. But when we come down to what we call economic releases and economic news, we can make some sense out of it. When an economics calendar release comes out, the market can react violently as traders enter and exit positions based on the new information. Now, some news events are more important than others, like the non-farms payroll report, which you all hear about if you're new traders, or you're aware of if you're existing traders, is the U.S. payroll data. It's on the first Friday of each month, and it creates huge market volatility. Then we have CPI or inflation data. Whether it's for the US, whether it's for the UK, whether it's for the Eurozone, has an effect on certain currencies or the currency for the country is being released on and will have an effect on the markets. And then, of course, central bank announcements. And they are one of the biggest watched events happening around the globe. Now, to understand how to understand or how to trade these events, you have to understand how they're all tied together. But these days, sophisticated algorithms are able to process news releases in the blink of an eye and move the market accordingly. Financial markets, therefore, adjust quickly to the new information. Even so, the biggest news releases create opportunities in the market because they can cause long-lasting price moves or momentarily distort the efficiency of the markets. Now, the economics counter is a fundamental analysis tool to help traders position themselves ahead of these events to take advantage of future currency movement as well as sometimes stocks, because the economics calendar also would include earnings reports, earnings events. Okay. Sometimes it even covers press conferences. Okay. All of these can have an effect. So crude oil, the weekly crude oil inventory, okay, again, affects commodities. Now, the economics tool, which is published daily, is the main trading tool for traders that use fundamental analysis as signals for entering and exiting trades. Economic and political news can change the direction of a currency pair and asset in seconds, and fundamentals that are true in one instance can be rendered absolutely meaningless by fresh fundamentals a few seconds later. Now, trading the news is a bit harder than it may sound. Trading the news is a little bit difficult to master because not only is the reported consensus figure important, but there are also what we call whisper numbers and revisions. Also, some releases are more important than others, and this can be measured in terms of both the significance of the country releasing the data and the importance of the release in relationship to other pieces of information being released. Now, the data being released on economics calendars. Okay, now a financial economics calendar sorts through all of the economic or the statistical data being released by countries around the globe and only brings in on the economics calendar for us those that affect the financial markets. But because this data isn't gathered for us as Forex or CFD traders, this data is part of government statistical analysis, understanding the economy. But if you're a healthcare worker, you have a human resources department, you're looking for very specific data. If you're a healthcare human resources company, yeah, you want to know the jobs market's hot, but you care more about only what's happening in the healthcare industry. And you might be more concerned with what's happening with people over 50, under 18. What's happening with people with this type of certification and not that type of, how many hours are they being offered? Are wages going up in that particular industry? Well, for a financial trader, we're not concerned with any of this stuff. We're only concerned with the overall big data. But these reports are huge. They are a huge government statistical analysis that have section after section after subsection after subsection. And the fact is, none of us really want to read these. You should always once or twice take a look at them. But there are huge books being released of data. So we have what we call the headline. And then some reports are important enough that they have secondary major events in there. Like the non-farm payroll report has the new jobs created. Then it also has the unemployment rate. And then it also has the wage and earnings growth. All of these are important, but there's only one major part of the event, one headline event, and several smaller ones. So you have to understand how to read these reports and how to use them. Because first of all, markets move a lot more in line with what the expectations are for an upcoming economic news release rather than what the actual news release implies. Meaning because traders trade their beliefs about upcoming news events often when the actual event or news release happens, the move is either over or ready to come roaring back in the opposite direction than the actual news report implied. So let's take a look at an economics counter. Oh, where am I going? I've got one set up for us. Hold on. I know I'm killing your eyes moving through this. Hold on, let me get this up on your screen. It should be popping up there momentarily. Okay, this is the economics calendar, the current economics calendar on investing.com. Now, you need to understand how to read this report, but tonight we're not going to break it down into section by section by section. It's very easy to learn about all of this and how to set your filters up, how to customize it, how to set your local times and all that based on the calendar you're using. But you can just go to Investopedia and look up economics calendar, how to use it, and it'll show you, because we're going to teach you how to use it, but how to set it up and make it your own or set it in your time zone, you can do that on your own. Now, when we see the economics report, and there are a zillion different ways to access an economics calendar. They're free all over the place. Whether you're looking at the Wall Street Journal, whether you're looking at investing.com, whether you're looking at Forex Factory, Forex Street, your brand's website. Now, the fact is, many of the economics reports or calendars look slightly different because that's up to the individual site to kind of try to create something unique for their branding. But the fact is, ultimately, they can't change much of anything because all of this data comes by feeds. And these feeds are being released by the government agencies and fed right into the calendars. And these events are fairly standardized, the time they come out, the asset they affect. Now, what surprises most traders for the first time is that all of these events are rated. Okay, they're called tiers. And these tiers are how important that data is to the overall economic situation of a country and what effect it will have on the assets. So the biggest effect will come with what we call top tier or level 3 data. Level 3 in the case of investing.com, they use 3 bullheads. 2 bullheads for level 2. Now they call it impact. But down here, they call it volatility. But it could be importance, but it all comes down to their tiers, their levels. Now, Forex Street uses, and Forex Factory uses 3 colors. Some use a 1, 2, 3 system. Some use, because that's one of the few things that can be customized. Still 1, 2, 3. But you can tell your system when it sees a 1, put a single bullhead. When it sees a 2, put a see when it sees a 1, put a yellow. When it sees a red, sees a 2, put it. So it's really, in computer world, that's all the same. Then the name of the event is standardized. Then we come to a couple things that are important. Now, this is one of the things they can customize and write on their own or get their own data. But when we see the name of the event, most of them will have a box you can click on or a detail box, or in this case, just a hyperlink, and it's going to open up some informational pages, which are very important for your analysis. Now, in investing.com, you get a description of the event. So when you see it, if you're not sure what it is, you can click on that box. You can see who releases it. And if you want to actually go see the actual release, you can just click on that hyperlink and go to it. See the currency that's affected, what country, you see the importance level. But down below, we have some charts that are important because we have one chart that's going to let us see how that event has happened or unfolded over the last 5 years. Okay. Or here you can click up to the last year, and we can see how that event has been, what the average is, and then we can actually scroll down and see the actual event releases and exactly what happened over the last 6 months or longer if you want to see. Now, for instance, FX Street has some incredible charts and everything else that they've built inside of each event to show you what effect it should have on what asset and how that asset should affect other assets. They've done a spectacular job. But you can pick out what calendar to use. Like I said, they're free. Find the ones that suit you, or you can go through multiple ones, whatever you want to do, or just use the simple one. Depends on how you're going to analyze the data. Now, once we come back to the calendar, we come to the important stuff. We see something that says actual, forecast, and previous. The most important column is right here. Now, the previous is pretty easy to understand. Previous is, if it's a monthly report, what was on this report last time it was released, 1 month ago. If it's a weekly report, what was released last week. And then we will then see, okay, now, when we're looking at a report and an event that hasn't occurred yet, the previous will always be in black. If the event has taken place, like all these are already passed because this is Thursday and it's already over, most of it's over, okay, we might see a red or a green. Red or green means that this event has been updated. Means that the last month's report has had some revisions, because this data is statistical data is being collected all over, constantly analyzed, and these agencies want it as accurate as it can. But sometimes they don't have all the data when the month ends, and they collect more data, or they do some more analysis through the month afterwards, and they see that there's been some distortions, or something wasn't right, or something came in late, and they will send out when the next report is released, they'll give a revision to the previous report. When this happens, we'll see a red or a green number. And if we put a marker on there, we'll see that this import price was revised from a 1.0 down to a 0.8%. This is important. You're going to see why in a minute. You have to be aware of these revisions. So we could see the initial jobless claims, unemployment in the US was revised in a favorable fashion. That's why we see it in green. And that was favorable for the US dollar and the stock market. Now, this is the revision. But that's only after the report is released. So let's go look at tomorrow's calendar. So we see all of the previous in black. Now, like I said, the forecast, which can be called forecast, consensus, prediction, is what the markets are expecting. It's one of the places you might see a variance between one website and another, because the government releasing agencies do not release forecasts. So these forecasts come from like Thomson's Reuters, other data collection agencies. A lot of times you read in Bloomberg and it'll say, our survey of 47 economists project that this report will be so and so. So if you're getting your forecast from Bloomberg, that's what's filled in there. Okay. If you're getting your forecast from Thomson Reuters, that's what's filled in. But they are virtually almost always the same. There's some slight variance, but they're usually exactly the same. And then when that release actually happens, we get what's called the actual, which is the true data. So I'm going to go over and take you back to the PowerPoint, and I'm going to tell you a story. So let me get my PowerPoint back up here. And I'm going to tell you a story about the economics calendar that I call the story of your kids' report cards. Now, you sit down on Sunday with your kids for Sunday dinner. And you know what? You're pretty lucky. You have pretty good kids. They're both in high school. And you say to your son, Well, kiddo, report cards are due Wednesday. He says, yeah, I know. Well, that's just like the economics count. Your report cards is it not an economic event, but it's an updated event on your child's education, just like an economic event. So you know way ahead of time when it's due out. You say to the kid, well, how do you think you did? Well, he says, Mom and Dad, as you remember, last semester, I brought you home 4 C's and 4 C pluses. Now, what is that? That's the previous. They say, okay. He says, I think I did a little bit better this semester, and I think I'm going to bring you home a couple B's and the rest all C pluses. Okay, so you're a proud parent. You trust your kid, you know he's a straight shooter, so you could set your hopes or your expectations or your consensus on his forecast. Now, you've set your expectations based on this. Now, you haven't done any analysis. You didn't go back to the school to find out if they changed the grading system. You didn't go back to school and find out how many kids got A's and how many kids got B's and how many kids got C's. You didn't contact the Department of Education to see if they lowered their testing scores or changed their standardized testing or none of that. Okay? It's just straight data. And that's the nicest thing about the economics calendar. There is nobody else's analysis. You're getting straight data, so you can analyze it. So it means you're getting the same data that a hedge fund manager is getting, that a big investment house is getting. You're getting the same information, not with anybody's spin on it. So now your kid told you he's going to probably bring home a couple B's and the rest all C pluses. Okay. You've set your expectations. Now, of course, you're good parents. So, you gave him a little lecture about doing a little bit better, a little bit less time on Facebook, a little bit less time soccer, a little bit more studying because he needs to get some scholarships to get into university. But that's all that's said about it. Now, come Wednesday, your kid comes running in the front door, hands you the envelope with his report card, goes right out the back door with a soccer ball to meet his buddies. You open up the envelope, pull the report card in, and he brought you home all B's. Much better than you expected. So since your expectations were exceeded, you're thrilled to death. Not that he did better than last semester, he did better than what you expected him to bring home. So now you're thrilled to death. You open up the back door, you holler outside, hey, kiddo, I'm going to put dinner away. We're going to go out and grab dinner, and I'm going to take you over to the sporting goods store, and you can buy that new helmet you were looking at. And you're all excited because he did really good. This is how the markets react. When the data is better than expected, you get a very positive response. When the data is worse than expected, you get a very negative response. But the idea is, how do you judge that response? Because if the kid would have come home with 3 B's and 5 C pluses, how much would you have responded? Because it was almost slightly better than your expectations. If he would have brought you in all C pluses, no B's, would you have yelled at him? You might have been in your heart a little bit disappointed, but it's still a good report card. It's just a little bit worse than your expectation. But if he brought you home all C's and a D, you would have been really upset. So this is where you have to be able to judge the market. And we call this setting market neutral, market positive, market negative. And how do you evaluate this data to see if it's enough that it's going to cause an effect in the assets you're looking at? Now, that is where it gets a little bit difficult, because then what happens, though, is that soccer ball comes through the picture window in the dining room, shatters the glass, And now you're all upset. You have to call the handyman and the glass fixed and take it out. You holler out the back door to get his butt inside and clean it all up. And then you're mad at him because you told him not to play outside of the house. And you say, there goes dinner out. There goes your new helmet. And guess what? Now you're just going to have grilled cheese for dinner. But I don't have time to deal with dinner because I got to deal with the handyman. This is what happens in the markets. You can have a very positive event, but a few minutes later, another event can overshadow that all. So it's a matter of looking and understanding all the events that are coming out and those responses also. Because on some days, especially the first week of the month, you can have event after event, and events are not related. You might be getting jobs data in the U.S., and then a little bit later, some market sentiment in the U.S., and some later, some speech from the Federal Reserve. So you have to be aware of the entire calendar schedule to see what it could affect. Because even if you're not trading from the economics calendar, you're trading some strategy you developed having nothing to do with economic news. And you set a buy for the euro at 123.5 because you're expecting the euro to go up. And you trigger that buy, you bought the euro at 123.5, but you didn't look at the economics calendar and jobs data or inflation data is due out in the eurozone. And as soon as you entered as soon as your buy was executed, that inflation data came and it was really weak and sent the euro tumbling, and you got stopped out of the market only because you didn't realize that event was going to happen. You could have entered the market after the event was over, or you could have understood that, okay, because the market fell down to 123.10, but recovered a half hour later because you weren't prepared for the volatility, so you didn't put your stop loss farther enough away that you just got stopped out in the swing of the marketplace. So this is a very easy way to start losing in the market because you just aren't aware of some event. And like when Mario Draghi speaks, he can drive that euro up and down because it flies up when he says one thing and his continuous speech and says something else, it can fly down. And if you're not aware of these events, you can get stopped out. Not necessarily debating what he's going to say. Maybe it's just saying, wait a little bit later to get in the market. Or if you're in the market, maybe I should sell or close my positions and take my profit now. But if you're going to trade from the calendar, you have to learn to put what's called market neutral, market negative, and market positive. These are the ranges around the asset that you could predict or you can estimate ahead of time. Because nice thing, the economic calendar is available weeks ahead of time. Now the consensus or the forecast data usually comes out about a week before the event. So it means over the weekend, you sit down and build your trading matrix for the entire week and determine what each event or pick out the top level events for the week, start learning about them, start doing some market analysis. This is one of the few times that you have tons of time ahead of time that you can actually prepare for an event down the road. So let's take a look at how we might do this. So what you're looking at on your screen is tomorrow's economic calendar. Okay. None of these events have taken place. They're scheduled to come out tomorrow. So we're going to take a look at building permits in the U.S. That is scheduled on the calendar at 12:30 tomorrow from GMT time. But if you notice, there are 4 reports coming out at 12:30. They're all part of the housing construction department. Okay? And they're all associated together. There's one 3-level event. That's the top tier data or the headline event. And these are sub-reports of that report, but they all have an effect on the overall market move. Now we can see, and this doesn't happen often, but we can see already an upward revision to the housing, because as they analyze this data and they see that the data is coming up, they can release a revision a little bit ahead of time, especially if it's been a big revision and been recalculated. So we already see that there's a revision upward. Okay, that's very positive for the U.S. dollar, very positive for the housing market. Now, let's isolate this event and build it into what a trading matrix. So what I use is I set up a little Excel spreadsheet. I have my building permits for February. It's due out tomorrow at 12:30. The assets it will affect that I've determined is the U.S. dollar, the S&P 500, perhaps gold, and any of the U.S. crosses, U.S. Japanese yen, U.S. Canadian dollar, had U.S. dollar, the euro U.S. dollar, because it's going to be positive or negative for the U.S. dollar. It is a level 3 top tier event. The sub-reports are the housing permits month over month, the building permits, housing permits, and the housing starts month over month. All of this comes right off the calendar. Now, the forecast for the building permits was 1,320,000 new homes. Building permits pulled for new home construction. The previous was at 1,288,000. Now, the sub-reports don't always have forecasts, and they don't always have important data, but we see building permits month over month are staying at 5, where the previous was at 5.90%. But it's a sub-level report. Housing starts been revised up. We're also expecting a number of 1,288,000. Now, what you have to understand is, and this is why it's nice that you have time to do some research. You have to understand the economic cycles, and the economic cycles from country to country can vary. In the US, we start out with building permits, because when a house has been sold, and in the US, a house isn't actually sold until it's delivered and paid for. So we have a house that went under contract. In other words, and then we have, this is new homes. Okay. This is not existing homes. That's existing home sales. This is new home sales. So new home sales start with a contract. Once a contract's been done and everything's been worked out, and sealed up in as far as the contract, when the builder is ready to start building, he will pull a building permit. When he pulls his building permit, that means he's getting ready to begin construction. Housing starts are actually when he actually starts the construction. Okay. From there, we go to new home sales, because the sale is registered when the finished construction happens and the house is finished and the house is delivered to the buyer and the escrow ends and the mortgage is in place or cash deal is gone and the deed is transferred. So you have this cycle, and this cycle has times to it. Now, there isn't a guarantee, because some builders build fast, some builders build slow. Okay, but there's things like we can judge it based on the pulling of building permits and the housing start, and we can see things when, like, if the Northeast has a very late winter, you'll see building permits pulled very, very late, because a builder doesn't want to pull a building permit till he's almost ready to start. And you see housing starts delayed. You have a very cold winter, because they're not going to start building until the ways, the frost, the soils, the temperatures warmed up and they can start working outside. Just like when we had the big forest fires in California, we saw a big drop off because all the buildings stopped, but also the people in that whole part of Los Angeles weren't pulling building permits. So there are ways to attribute, and yet just because building permits falls or housing starts misses, doesn't mean it's a bad sign, because we have to go back and analyze what could have caused this. And will it bounce back next month? Because it will eventually fill that cycle. So you have to learn that cycle. We also have to go, and like I showed you on the live charts, we can look at these reports, okay, which I just screenshotted and copied over here. So we can see since October of last year, that this data has been pretty much well above the forecast every time, which is good. The housing starts have building permits have been growing steadily, and they should grow steadily as we move from the winter to the summer, because we're pulling building permits, in December, January, and February, because we want to start building as soon as the winter is over in the Northeast. Okay. And again, things are cyclical. Like in the U.S., because this is U.S. building permits, they want to, if they're buying a house and they want delivery, most people want it delivered, okay, in August, so they can be moved in, so the kids can start school in their new schools, in their new home, in their new district. So you'll see a surge of maybe 6 months or 8 months before in housing starts, and you see a surge rate before that in building permits. After that, we have the winter, which affects them. So you need to understand the cycles. We also can see on this chart over here how steadily they've been increasing in the U.S. And then we can also start to see, because you have no idea when you're starting out what these numbers should be. So we can see that these numbers always stay over 1,000,002, 1,000,003. That's a lot of houses, especially if you're from the UK or from Australia, where new home sales are relatively small. In the US, it's a huge number. And you can see where they stay, how well they do, because you need to have this information to start building your trading matrix. Because remember, your trading matrix starts out with what is market neutral. Market neutral is the zone around the forecast that won't have a significant effect on the markets. Well, we can see that these reports usually come in a little bit under the market. Okay. Now we can start to see I have some students who take all the forecasts, add it all together with an average variance. Others that add all kinds of statistics to come up with what market neutral should be. I just look at numbers. I don't do any mathematics. Okay. I see the previous is 128. I don't really care that much at the previous. I see the forecast is 132. Well, in my head, since I know these numbers are large, okay, I'm going to have a zone around this 132 that I'm going to call market neutral. Well, I can see that there's fairly positive. We have a negative number, a small n negative number, and we can see it's always a little bit over expectation. So we're going to say at 1,000,032, market neutral will be anywhere from 1 million, say 1,000,029, okay, to 1,000,035 would be neutral. Because it doesn't mean you don't have to be exactly accurate. There's no accurate number here. You're just guesstimating. So we're saying if this report comes in this zone, it's not going to have enough effect to make an asset move or make it tradable for us. Then we have to set the range that we think would be what we call market positive. Market positive is a number high enough above the forecast that you have that really good response that you promise the kid to take him out and buy a new helmet. Well, if this report's 132, okay, we can see that it usually comes out a little bit ahead. So we're going to say, but we set our zone at 135. So we're going to say here, anything better than 136 is market positive. Here we set our low end of neutral at 129. So we're going to say our market negative is at 128. That's 1,000,000.28. So now we've set our zones. And We know anything above 1.36 is positive for the U.S. dollar, should help push the S&P up, should help the U.S. dollar, should weigh a little bit on gold to push it down, and should make the euro dollar drop a little, okay, and maybe the pound dollar. But it's going to make the U.S. dollars strong, depending on what crosses you sell, you're interested in. But we don't end there. We have to go on to the other sub-reports because we can't ignore them. So this is what we call put on the bumps. The bumps are only on the sub-level reports. And these are simple bumps of positive or negative. So our building permits month over month is expected at 5.9. If it comes out pretty much at 5.9, 5.8, 6.0, it's nothing. If it comes in 6.0 or higher, we're going to give it a plus bump. If it comes in 5.8 or lower, we're going to give it a negative bump. Housing starts are expected at 1,288. Okay. We already have a revision upward. So that already moves it over to the plus side. And if this number comes in better than expected, that's a bigger plus. If it comes in less than expected, it's about a wash because we already have a big jump to last month. Then we have housing starts month over month. If this comes in somewhere around the 9.7 level, it's market neutral. 9.8 is a plus. 9.6 would be a minus. Okay. Why do we do these? Well, let's say that this report, the headline report, came in at 132, right on the money. So that would be dead center market neutral. But each one of these sub-reports were positive revisions upward, and all the numbers came in better than expected. So you have all of these bumps. Well, these bumps are enough to knock this just over to market positive. Or if you had an event that came in a market positive, but you had lots of downward revisions and weak sub numbers, it could mark it back into market neutral. And once you determine what range is in a market neutral, market positive, market negative, and you set up this whole chart before you've already built your ranges and you're just waiting for the actual results to click off the boxes to see where it ended up. And you've already what asset you're going to do. Now it's simply deciding how you're going to trade that asset. Okay. Will you put it on a chart? If it's a positive number, will you wait for it to break its next resistance level and put a buy order as it breaks that resistance level? So a weak number, will you put a sell order in when it hits its next breaks its lower support level? What price will you enter the market? Those are simple numbers, but you can't do those to right at the event or pretty close to the event. But now you have some decision-making capabilities. Because you have to decide where you're going to put your stop loss, where you're going to put your take profits. You have to decide what the market volatility is going to be caused by this, and that's why we're using these ranges of bumps. Because if the market comes into market positive with lots of bumps farther above that number that we expect the market above, that gives us a higher range or more momentum. You know, if it just hits in the market positive, it might push that asset up a little bit, but not a huge amount. So you have to use your own experience, knowledge, but now we're starting to make educated decisions. And this is how we would analyze the markets and figure out what we could do to prepare for the event before it is actually released. We do have short-term and long-term effects to the market. A lot of people don't want to play the short-term game. It's risky. It's got a whole bunch going on, but you just the same if you lose long-term. But if all that housing data came in, it's going to have also a long-term effect on the U.S. dollar. Not as radically, but this all together is saying the U.S. economy is doing good, the housing market is doing good, so the dollar should be seeking a new level higher than what it was. Okay, so you could wait a couple hours the next day and then trade the dollar because it's up positive news. But remember, you always have short-term events following here and affecting it. So to trade news on short-term basis, the trader must have a clear criterion of what kind of news will justify a trade. Many news traders seek at least a 50% surprise in data to consider a reason for trade. A novice trader can use the initial period of his trading career for perfecting his money management skill. Trading news on a short-term basis can be easy and lucrative if the trader is disciplined enough to cut losses and accumulate profits. Panic and mood swings and undisciplined methodology will quickly erase all the gains from shocks and volatility. So, on that note, I hope I've given you something to leave with and ways you can start practicing. So, nice thing is, you can go use a demo platform on www.tradetime.com and try these out. Build your matrices, use your economics counter, do demo trades, see the market and how it responds to these events. And these same events are repeated month after month after month after month. Okay. And once you got that path, once you got a whole cycle of that, maybe amazing trade that in real money. But there are many ways that you can incorporate the economics count into your trading routine. So thank you very much for joining me tonight, and have a great weekend. And once again, www.tradetime.com and set up a demo account. Give them a shot. You'll find it's a very unique platform and broker. And if you want to see a recorded version of this class, just go to investing.com and look under webinars, and you get access in about 24 hours. Have a good night now, and thank you for supporting Trade Time and investing.com.